Hi, everybody. My name is Matt Brown, and welcome to the Direct Private Investment Show. With me is Bruce Roberts. Bruce Roberts, welcome to the show.
Great to be here, Matt.
Why don't you quickly give us the elevator pitch about who you are and what you look after here at Carofin?
Sure. We're an investment bank. We are what's called a registered broker-dealer with the regulatory authorities in the United States, think of FINRA. Within that world of broker-dealers, about 3,200, we are highly specialized in the area of private finance. So what we do, we're bankers. We work with companies that need capital and raise capital through by creating a security, and we work with private investors. And in our case, these are investors that meet an accredited investor standard, which is often saying high net worth individuals, family offices, private funds. So all we do is private finance. We've been doing it since 1996 through some various predecessor companies we have. We raised about $1.25 billion, both debt and equity. So essentially, we'll work with a company that needs capital. We'll evaluate their circumstances. We'll discern what type of security is appropriate, debt or equity, and then we match that up to our investor base and make sure that they're being shown investment opportunities that match their goals and criteria.
Cool. So let's talk about securities. So today, guys, we're going to be talking about securities and really demystifying exactly what they are, different types of securities, etc. So Bruce, you're the experts on this subject.
Right.
So let's get some fundamentals out of the way. When you say security, what do we mean? And then I'd love for you just to shine a light on debt versus equity.
Well, there may be more exciting topics on the planet than what is a security, but I will do my best to make this come alive for people.
I'm sure you will.
In its essence, a security is nothing more than a contract between a party that needs capital and a party that has capital. The terminology that we use, it's a financial instrument, but the terminology we use is if it's a loan, then it would be debt. If it's an equity interest in a company, then it would be called equity. But I would want to point out early on for the audience, you owe it to yourself to take Accounting 101, not 102, not 103, not 201, the basic level of accounting, so that you know what a balance sheet is, what an income statement is, and what cash flow really means. Because without being equipped to that, knowing what that accounting is, that's the language of business, it becomes pretty hard to really evaluate a security and what it might mean as an investment because you're not speaking the language.
Got it. So do 101 accounting, like know the basics before you get into the space.
Right. So I'm going to focus on the balance sheet because that's where the security resides. A balance sheet has, as most people would know, assets. Those are physical things. That's cash. That's money, short-term money owed to you. Liabilities, short-term liabilities, things you owe other companies. It could be long-term debt. But also on that side of the balance sheet, you have equity. So what we're talking about when we talk about security is what we would call the right side of the balance sheet, where you're looking at either liabilities, that would be debt, or equity, that would be an equity security. A liability, by its nature, is a fixed obligation. So if I owe you money through a note, then I've said, I'm going to pay you whatever amount you forwarded to me on some basis. That would be the maturity. And then I would say, okay, you're giving me your capital. You don't have needs of it. So it's fair that I pay you some rate of return or interest on it. And those numbers are, in the case of the private world, are all negotiated, not necessarily the amount you owe, but the interest rate. Then the other question is, well, what forms of repayment do you have? So for a debt instrument, you can be secured, and secured would be collateral. So most people, or many people on this phone, would have a home mortgage. Well, it's not a security, it's a loan, and that gets a little gray as to what's a loan and what's a security, but suffice to say, it is a secured instrument. You're saying to your lender, if I don't pay the loan, you can come get my house and you can get your money back. But when you issue a secured note, it's very similar. In our case, the collateral that would be a secondary source of repayment could be everything from commercial aircraft parts to some agricultural product to, could be any number of things. Depends on the company. It depends what they have available to offer as collateral for the note. Most of the advances that we do through notes are collateralized. Most of them are actually for our short-term nature. So in other words, they're no longer than 3 years of maturity. And then from then, everything gets different. So some of them are 1 year, some of them are 2 year. The key when you're a banker and you're creating a security is to make sure that the security matches the circumstances of the issuer. And another classic way to look at it for those who are looking at credit opportunities is the length of the liability should roughly match the useful life or the length of the asset that you're financing. So if it's short-term debt, for working capital, let's say you're financing payroll or you're providing capital until money's been received from selling your product. Well, normally that's less than 120 days. Maybe it's going to roll over. You're going to be doing that on a continual basis, but you're not going to issue a 10-year security to finance the short-term assets of the company, right?
Yeah.
So, Matt, that's on the debt side. Equity is a very, very different animal. And I should say, before even I go there, companies really don't have any business issuing debt if they don't have sufficient cash flow that they're generating from operations to pay the debt and pay both the interest on the debt and pay back the principal on the debt. So that's kind of a general rule of thumb. If you're investing in private credit, you should be spending the time to understand, does this company make money? And in the form of cash flow, not a book, but actual cash. If they're not, and now we're in the world of venture capital, then these are the types of companies that generally are going to be issuing some form of equity. And don't be confused. Many times they do issue a convertible note, but you're really taking equity risk. This isn't a company that has the cash flow to pay back that note. You use a convertible note structure to maybe delay setting the valuation or any number of things. But to keep it simple, for venture stage businesses, again, those not generating operating cash flow, they should be issuing equity. And then that equity will give that equity holder a claim on future profits of the company or on future value of the company if it's sold, for example, or if it is large enough to be able to go public. Generally speaking, we sell debt securities to folks who need current income from their investments. We sell equity securities to individuals or funds that are structured where they're really looking for a capital gain or delayed repayment. Generally speaking, interest will have a lower rate of return on it because you're getting your money back faster and you might be secured. Equity, you should expect a much higher rate of return, and you can't secure equity. So, what you can be is first in preference for getting paid back as an equity holder, but you won't have hard collateral underneath you that you can claim.
Thank you so much for that, Bruce. So I'm curious though, do you do both types, debt and equity securities at Carofin? And when do you choose one versus the other?
Right. We do. As bankers, I take a fair amount of pride in the fact that we come into a conversation with a client, a company that needs capital, being fairly agnostic about, do we issue debt or are we talking about a debt security or an equity security? Because a very important part of our practice is the security that's being offered has to match the circumstances of the issuer. So yes, we're bankers who are looking at the entire balance sheet at both liabilities and equity. And we have a very broad investor base, and some of those investors are looking for current income, which would align with a debt investment, or they're looking for capital gains, which will align with an equity investment. But fundamentally, as bankers, we want to be problem solvers for the companies that we're representing, and we're bringing them a solution. And of course, the common theme of these companies is they need money. Well, our job is just not quite good enough. To need the money is fine. Everybody needs money. What type of money is appropriate here? And again, debt or equity, and again, circumstances dictate. And that's the starting point, is this an appropriate company for one path or another?
Mm-hmm. Could you also just touch on some of the risks of debt versus equity too?
Well, let's take it in reverse order, because I think you need to understand the risk, because the risk drives the return.
Right. Just it.
Right. So in the case of debt, you've got a fixed obligation. In most cases, you'll be collateralized by some assets. So you have two sources of repayment: the general obligation of the issuer and the ability to sell that asset. We have circumstances right now where we have been financing a company for some time. We are actually restructuring the debt. It has amortization. In other words, the payment, the principal is being paid back on an ongoing basis, but they've hit a wall in business. And this is what happens if you're looking at, we're talking about high risk securities. We're talking about fragile companies. But even when you issue debt for these companies, the investors you go into it expecting the deal that was offered you, but in the back of your mind, you got to be thinking, I may have to be flexible in terms of how I'm getting paid if circumstances change. We have plenty of cases where we've had to restructure the debt of an issuer. Give an example, COVID. We were financing a company that sold commercial aircraft parts and had a very successful business, husband and wife team. They'd been doing that business as a business for 15 years. They'd been in the industry, each of them, for over 30 years. Well, when COVID hit, commercial aircraft flight fell off a cliff, as we all probably remember. and planes were parked on the tarmac, and they weren't getting regular maintenance. Parts weren't being replaced. This company's business dropped by 50%. So we went through forbearance, and we said, okay, let's go to an interest-only payment because they could pay the interest, and let's push out the maturity, and we'll revisit this in 6 months. And in fact, we did that. And I'm happy to say that particular company actually repaid all of their debt now that we're this far through COVID. But yeah, I do kind of want to put that out there. But to kind of get back to your question of kind of the relevant risk in debt, you've got multiple sources of repayment, or at least you should. And in debt, then the question is, if you get into situations where the courts are involved, how are the courts going to rule in terms of your debt? And this is getting way beyond what you probably want to get into in this presentation. But suffice to say, this is why you do have lawyers involved before you make a loan who are specialists in transactional work, so they can know that you're protected in the event of bankruptcy. And debt, by its nature, would be the first parties to be paid off if you say liquidating the assets. Equity is a much higher risk security. There is no collateral underneath that security, and you're really along for the ride to see how much equity value can be created in the company. And that equity value is going to be a function of, could be any number of things, but the base of customers and the product you're selling and the profits generated by that classically. To get to rate of return, you could, the debt markets by their nature tied to fundamentally the U.S. Treasury market. So in the Treasury market, you've got short-term debt, you've got long-term debt. As this is being recorded, we're in a fairly unusual circumstance where short-term debt often is not as a higher rate than long-term debt, but in a normal, what we call yield curve environment, short-term debt's relatively low, longer-term debt is higher. Certain markets trade as a spread to where those rates are. In this market, it's a bit different. The risk is the risk is the risk. And so, we generally take a view that if you're buying investments in a private company, private lending markets, you're going to be in sort of an 11 to maybe 15% interest rate environment, even when interest rates are zero, because that's literally the risk you're taking associated with that obligation. And I think that's a pretty good rule of thought. There are times when even more is needed, but I would caution investors, just because you can tack up a higher rate doesn't mean you should, because at some point, nominally, companies just can't service debt that's that expensive to them. Equity, a rule that I was taught years ago was 10 bags in 5 years.
What does that mean?
10 bags in 5 years, if you run the math, works out to a 58% internal rate of return. And if you're doing an early stage venture, that's what you should be looking for. Because on a portfolio of venture companies, you're going to have losses. And what you would hope is that your winners, who might be much higher than 58%, carry the losers, and across the portfolio, you've done well. Now, a big part of what we do every day is try to mitigate risk for every security we bring. But when you're into venture capital, things happen, things don't materialize. And so you look at it on a portfolio basis, you make sure every security in the portfolio, it's a certain minimum threshold. And I would say for earlier stage venture, at least 50%. And of course, there's no upper limit if you think it's going to do better. Later stage companies, like when you look at what we would call the private equity world, where a company has cash flow and you're valuing it based on cash flow, that would be no lower than 25%. And really, you're probably more in a 35% range. I know these are high numbers, but this is where you need to be with equity risk. And then if you're investing in real estate, where you really do have a real asset, you may not be first in line or collateralized, but you've got a hard asset there, and presumably it's been funded at a lower rate than it's worth. Those can go a bit lower, but let's say that's in the high teens to low 20s is typically where an equity return would be for real estate.
Thank you so much for that, Bruce. I'm a lot clearer now on equity versus debt. So what's the key takeaway here for investors when it comes to different types of securities, equity versus debt? What's the key thing you want to land with them?
Well, the first thing is, look in the mirror and find out what you're trying to accomplish with this part of your investment portfolio. If you're looking for current income, you have no business investing in equity. And if you don't need current income and you're willing to take on more risk and play the longer game, then you're really in the equity camp. Your age has something to do with it. I think I'm a little older than you are. So somebody around my genre is probably, buying debt these days. They might still be buying green bananas, but they're also buying debt because they're probably not getting enough current income out of their bond portfolio, and maybe they need it. We got a little inflation these days, so a little more return doesn't hurt. Someone like yourself would tend to be more equity weighted. Now, having said that, when you get to ultra high net worth individuals and they're really investing for the next generation, then the current income, that math kind of goes out the door, because let's presume they're perfectly liquid to the extent of supporting their lifestyle throughout their expected life cycle. But if they've got heirs and they've got an estate and they have a much longer perspective, that is a scenario where a much older investor is really investing for the next generations, not for themselves.
Thank you so much, Bruce. I'm a lot clearer on different types of securities and when to choose what versus the other. And I'm sure the key thing for me as an investor too is to rely on experts' advice and guidance from a firm like Carofin. So thank you for being on the show.
You bet, Matt. Thank you.